Welcome to the show, Alan.
Really happy to be here with you. Happy to educate your audience on how to evaluate and invest in real estate private equity funds.
Fantastic. We are so excited to have you here today. Now, your professional credentials are remarkable. 40 years is a long time of investing and advising your clients. Can you walk us through your journey of how you started in real estate to where you are today? Give a little bit of background on that so our listeners can learn more about you.
Sure, it's been 40 years, but I'll try to keep it short. After business school, I worked throughout the 1980s, generally in merger and acquisitions at a couple of large investment banking firms, then formed a SEC FINRA broker-dealer that I ran for about 25 years, had a private equity hedge fund for about 12 years, and was looking to invest my own capital. Didn't really know a lot about real estate, and now realize that I should have started in the 1980s in real estate. It's the best asset class, generally providing the highest rates of return at very modest risk levels. So I'm happy to be focusing for the past 10 years on investing in real estate.
Fantastic. Now, in addition to the high returns, what are some other advantages that real estate offers, in your opinion, that other asset classes may not offer?
Right. So the advantages are really in comparison to stocks, bonds, or cash or commodities. So the leading five, and I can go through each one. Real estate has the best comparison to other asset classes in terms of it being a hard asset, producing a high cash yield. It's leverageable from virtually every financial institution. It's got tax advantages in the form of depreciation. And over time, there's an equity buildup. Typically, rents increase, the value increases. And so, it checks those five boxes in having relative benefits to stocks, bonds, and cash.
Now, can you help us understand what real estate private equity funds are? Why should an investor invest in them as opposed to, say, investing in a REIT?
Right. So
that's two questions.
So REITs are attractive for one main reason, and that is that an entity is investing in real estate on your behalf. So it's a passive investment, and it's typically a public entity. There are some private REITs, but typically you would invest in a REIT because it's a public entity. The downside is that REITs are not opportunistic in their investments, and typically there's very high costs associated with being a public company, such as the enhanced public company accounting. The legal fees just to get a REIT off the ground are several $1 million. And so the distributions that REITs provide typically are around 3.5%. They have done extremely well in comparison to other stocks. In fact, when you look at the last 10 years, I believe REITs were the number one performing stock sector in comparison to energy and high tech and financials. REITs are right up there with the number one spot in something like 4 of 10 or 6 of 12 different years. So it performs very well, but not as well as real estate private equity funds. And the reason that private equity funds typically outperform REITs is because, one, the REITs have very high fees. Two, private equity funds are able to be more opportunistic in their acquisitions. They're in a position to buy distressed assets, while REITs are typically looking to buy assets that are providing significant distribution. So that is a good aspect of REITs. You get good distributions, but if you hold REITs for a longer term, the capital gains are underwhelming while the capital gains from a private equity fund are usually fairly spectacular because rents have gone up, and depending on where cap rates have gone, you can get a very significant capital gain from a investment in a real estate private equity fund.
Great. And can you share some more attributes of a real estate private equity fund?
Well, the the primary ones are the number one attribute, and it's the same actually in a REIT, is diversification. However, you don't get diversification from sponsored deals. You don't get diversification from a crowdfunded deal. Any deal by its nature is going to be one asset. You don't want to have that one asset in Florida, in Fort Myers when there might be a hurricane, or in Houston where there might be a flood zone. So an important aspect of any investment, and which is true in a real estate private equity fund, is diversification. Another element in a real estate private equity fund is that because there's a pool of capital, they have funds available to hire an entire investment management staff. So attribute number 2 is a large professional full-time investment management staff covering areas like capital markets for raising the debt capital for acquisitions, the value add improvement staff, which handles all of the ability to improve properties, the acquisition staff and disposition staff, and then financing staff. So all of those are embedded within a investment management company, which leads to a safer return because all of those are taken care of internally by the company. In addition, a real estate private equity fund will pass through the tax benefits to its investors, whether that's through an LLC or an LP structure. The one best attribute is that the real estate private equity funds tend to outperform all other real estate investments. And the reason for that is you don't get to be a blind pool private equity fund manager right out of the gate. You have to have a substantial body of acquisitions, 50 million, 100 million, several hundred million, so that you develop a following of high net worth investors, family offices, institutional investors. And if they've done a lot of single asset investments with you, then at some point they begin to trust you and they provide that capital, that investment capital to you in a real estate private equity fund. So anytime you see a fund manager, it's likely that they have a prior track record. And usually those track records are quite significant. As you can imagine, if someone's not performing well in a bunch of individual deals, they're certainly not going to be able to raise a blind pool from investors that they've disappointed. So private equity fund managers that have a strong private prior track record generally are outperformers, and the institutional investors that participate in real estate private equity funds are typically family offices and institutional investors, and they will always require an audit and an administrator to help manage the governance of the fund. So if you're a investor in that fund, you're benefiting by the institutional investor demanding that there be an audit and administrator, which adds to the safety of a fund.
Now, there are a lot of different real estate funds out there. What kind of due diligence can an investor do to help pick the best ones?
So it's fairly difficult for an individual to perform his own or her own due diligence on an investment fund manager. It sometimes gets quite technical. Most people might be familiar with some real estate terms like cap rates and cash on cash returns. But in terms of a investment fund, they may not understand limited partnerships or LLCs. But in general, when you're reviewing a fund manager, first thing I look at is track record. Someone has performed poorly generating either negative returns or even single-digit returns, that would not be an investment that I would choose. So track record is number one. Second would be strategy. Is that fund focused on multifamily, industrial, medical, office, retail, hospitality? And what is the outlook for those different strategies? So currently, multifamily has been in favor for well over 10 years and probably off in the future for the foreseeable future, because everybody's got to live somewhere. We do have a growing population, over 2 million more Americans per year. Right now, there's about 350 million Americans. Census Bureau says there's going to be 440 million by 2050. So over the next 30 years, steadily 2 million more Americans, typically through immigration. There will be more people in the country putting demands on housing and rental properties. So multifamily is quite attractive. I also like industrial and a couple of other areas, medical. Clearly, because of the pandemic, the three sectors that have suffered the most are office, retail, and hospitality. Not that they're bad, but it's a difficult, tricky market to be investing in when people are leaving offices, that retail still has not come back. Hospitality, people are just not traveling the way they used to. So for my money, multifamily and industrial are the safest. And then if you're researching private equity funds, you want to make sure that they have a full range of capabilities, including the acquisition of properties, the accounting for properties, the capital markets, or the ability to obtain debt financing at the best possible terms, and then some element in the company that can handle the disposition of properties, so that that full range from purchase to selling is taken care of. In terms of demographics, you want to make sure that the particular market that your fund is investing in is growing and that rents or investment values are going up. So you want to look at growth markets. We have targeted for the last couple of years on multifamily, generally in the South and the West, although California is maybe a little less attractive these days. South and Southeast, ranging from North Carolina, South Carolina, Florida, Georgia, Texas, Arizona, are all states in which the population is growing. And typically when businesses move to those states, they are high-tech businesses where the average income for those new employees of those companies, like Tesla moving from California to Austin. So those new people moving to Austin are typically being paid more than the average. That is a good sign that there's demand for properties and demand at higher prices. That would be a solid growth market for our money. And then you have to understand, for a given strategy that might be development, value add, distressed, where are we at in an investment cycle? So today, development is not quite as exciting as a value add strategy, because there's literally this year, 2022, and into 2023, there's not a lot of new home purchasing going on, primarily because people aren't leaving their old house where they had refinanced their mortgage at a low rate in order to buy a new house where they might have to take on a new mortgage at 6 or 7%. So development of properties, and I believe that single family residence strategy is not as attractive right now as it might have been a couple of years ago. I like the value add strategy where you can understand where newer properties are renting at, and if there's a inefficiency or a big gap with rents at a B-C class level, then a value add strategy would be attractive. So those are approximately 6 of the areas that we look at when we're looking to invest in a real estate private equity fund.
Can you talk about your company, CityVest, a little bit, and what's unique about it as a company?
Yeah, so I started investing in real estate myself and had invested in sponsored deals and syndication and a couple of crowdfunded deals. And across the board, they generally underperformed single-digit returns, low teen returns. But I know that a lot of funds were generating mid-teens and even 20% plus kind of returns. And so when I started to analyze other investment vehicles like real estate private equity funds, I did see, at least in the mid-tier size funds, not the big funds like Apollo or Carlyle or Blackstone, which generally buy core properties that don't provide the level of upside as some value add or distressed acquisition funds, but some mid-sized funds generally with 50 million in assets under management, or in a current fund up to about 300, they do tend to outperform. And so I started to look to invest in those kinds of funds and did see that they outperformed the very large Blackstone, Apollo, KKR, Colony, Carlyle type of funds. The problem is the very best funds that generate the higher returns start to raise much more capital. And when they start raising more capital, the minimum investment size starts to go up. So it's not uncommon for the minimum investment size in a private equity fund to be $500,000 or $1 million. That level of investment becomes cost prohibitive for most accredited investors that might be interested in investing $25,000, $50,000, $100,000, even $200,000, but they don't want to invest $1 million. An accredited investor typically has a net worth of $1 to $10 million. And so investing a whole $1 million in one fund would not be a safe diversification of one's investment allocation. So I started to invest in private equity funds by creating a feeder fund with my brother and a couple of other investors. We pooled our capital together and met. The first fund was a $500,000 fund. We met that minimum by having a pool of capital. We did this a couple of times, and the fourth time around, we had 4 million. And I asked the fund manager, because we have a pool of a couple of million, do you think we can get better investment terms? And they agreed. And that was my light bulb moment that maybe I can create a business forming feeder funds, finding the best funds that are out there with the due diligence skills that I have, and then having third-party investors come to a website reviewing all of the aspects of the fund. And if they want to invest, then they can click a button, invest now, participate in that group, and the group of us will get an enhanced investment term as well as access to that institutional private equity fund. So most of our funds today we're receiving through a side letter agreement with the private equity fund, we're receiving a 12% preferred return followed by an 80-20 split. And the question I get most often asked is, how did you get a 12% pref when the underlying fund is offering a 6% or 8% pref? And it's because they want to be raising capital in larger chunks. If they can raise 3, 4, 5 million from one investor, that makes their life a whole lot easier. And for them, they will still earn their fees. They will still earn a percentage of profits over that pref. It's just our pref that we're going to receive is going to be 12%. So it's this is what CityVest.com does. We create feeder funds. We locate, we research 700 funds a year. We locate the best ones. We negotiate a side letter. On the website, we have a third-party due diligence report on each of our funds. So it adds a level of safety, given that a third party is checked on key man life insurance, validated that there's an auditor and an administrator, done background checks on the individuals that are managing the investment management company, and looked at their years and dollars of experience to make sure that they qualify to be a institutional investment fund manager. So CityVest does all of this work. we do earn a fee from the Access Fund, but it's far smaller than the 4 to 6% increase that we're able to obtain in the preferred return from the underlying fund.
Fantastic. Now, a question I get a lot is it a good time today to invest in real estate or a fund, if you will, with the current environment? What is your opinion on that?
That's a question I get every day because everyone's lost money in the stock market.
Correct.
Everyone's lost money in the bond market. Many people are turning to real estate because it's been a solid asset historically. And then they ask the question, where are cap rates? Where are interest rates? Is now the time to invest in real estate? Frankly, I have not thought so since March of this year. And we've pretty much, we did one investment in April, but we've pretty much stayed out of the market for well over 6 months of this year. We didn't know where interest rates were going back in June, July, in the summer. Interest rates were still going up. And in fact, just this week, we had another 50 basis point increase in the Fed funds rate. And we're likely to have another one in January, another 50 basis points, and maybe even another in March of an additional 50 basis points. So we know that interest rates, mortgage rates on the debt financing component of a real estate acquisition, that cost will be going up. We've seen that the valuations of real estate have stubbornly not gone down enough to reflect the higher price of that debt financing. So we've waited. And it's very hard to buy real estate and make a good return when the cap rate that you're buying the property might be at 5.5%, and the interest rate that you have to pay on that property is at 5%. So we've been waiting. We finally, just in the past couple of weeks, launched our first offering in the past 6 months for a fund named Croatan Multifamily All-Weather Fund 2, and CityVest Access Fund is called Croatan Access Fund. The reason we're investing in this fund, particularly today, is I want to give them opportunistic capital. They will have capital in the bank to deploy their multifamily acquisition strategy. They're far better at buying property than anyone else I've seen. They bought $1.5 billion in properties in the past 18 years. They've exited or realized on $663 million of property, and on those realized properties generated a 32% IRR. So that puts them in the top decile of real estate fund managers. They've got 18 years experience. The chief investment officer of this fund, Croatan, is investing $7.4 million into his own fund. It's audited by KPMG, and we were able to negotiate a 12% preferred return, followed by 80% to profits. So this fund has all of the ingredients, checks all of the boxes right now. Now, they're not going to invest this money next week or even in January, but they will have the opportunistic capital in the bank when they find an acquisition. And I believe they will find a great acquisition because they've got over 20 employees in the company in 6 different offices throughout the South, which is the area that they target their multifamily acquisitions. And with that capital in the bank, real estate brokers looking to sell a property go first to real estate funds who have money to close. A real estate broker would be foolish to contact a sponsor or syndicator who might be able to make an offer, but they certainly can't close quickly on a given property because they need to raise the equity capital. But a real estate private equity fund like Croatan can move very quickly. They've got the capital in the bank. And because they have 18 years experience buying properties, every well-known real estate broker selling a property knows Croatan. They've got a long history of making acquisitions. And with this new fund that they're raising, they'll have capital in the bank to actually deploy. And so they will be first in line, particularly if there's a distress situation, which I believe the next year will produce a disproportionately high number of distressed real estate sales, just like there were in 2008. I don't think 2023 will be as bad an economic period as 2008 because lending standards have been more appropriate the last 10 years. But nonetheless, there have been a significant number of properties financed using bridge debt and adjustable rate debt, many of which, if they were smart, they had caps. But even with the caps, which might be at 4 to 5.5%, even with those caps, the net operating income of individual property syndications or sponsored deals or crowdfunded deals, many of those properties will have negative cash flow when those interest rates hit that cap. And mortgage prices are going up. So there will be continuing distress from the debt financing, chewing up all of the net operating income. And there will be, I believe, billions of dollars of properties which the sponsors cannot meet the debt payments. Banks and other lenders will foreclose on those properties and will be looking for real estate acquisition companies to buy those properties, and a fund like Croatan, again, with capital in the bank, with their history known as real estate acquirers, will be in the front of the line, ready to buy those properties at attractive prices. Hopefully they are lower valuations, higher cap rates, and at attractive financing costs.
Fantastic. Now we are just about out of time. Before we go, is there anything else you want to add or say to our listeners? Any piece of advice or anything you want to add?
No, I'm happy to talk to any investors that are confused by where we are in the life of making real estate investments, or if there's any confusion about a real estate private equity fund versus a single deal, or even if you have a question about some of the private equity fund documentation that can be quite confusing, like preferred return, waterfall structures, fees, the term extensions, K1s, targeted IRRs, catch-up provisions, rebalancing contributions. Real estate private equity funds are an analysis in and of themselves. CityVest is an expert in doing that, and we hope to bring those products to investors so that we can have the safest and highest returning investments for our investor clients.
Yeah, I can see with all the terminology how a novice investor can be confused. So how can people get in touch with you?
Yeah, happy to speak to people. First, go to cityvest.com. There's a button that says investments, so you can review any of our investments there.